green. Let's take the discussion forward on the fundamentals with Pratik Gupta joining us, the CEO and co-head equities, institutional equities at Kotak. Pratik, morning. Thanks for your time. It's been, a pretty wild last two trading sessions. What were your observations on the way, and more importantly, what the market's reading of the political dispensation is now and the way reform, etc., would take shape?
Hi, good morning. Thanks for having me. Yes, the election result was a bit of a surprise for most global as well as domestic investors, and that's why we saw the sharp reaction first on Tuesday. But then as it dawned that, look, you'll probably have a coalition government, which is the view right now, and this government will last the next 5 years. And we saw some more announcements yesterday with the coalition partners giving support, and that's when the market rallied. So we think there was a little bit of a knee-jerk reaction on Tuesday, but the initial jitters have sort of settled down. Most investors are back to sort of business as usual. We think the worst is over from a political risk perspective. And also, I think from a economic growth agenda perspective, we think some of the concerns are overdone. There was a lot of chatter that this coalition government would be forced to get into welfare, populism kind of measures. That we think is unlikely. We think there's enough cushion on the fiscal deficit in any case for some minor sops to the alliance partners, but no major earthquake as such. So we think it's back to business as usual. We think the economy will grow at 6.5–7% this year and for the next 2 years. The macro environment is extremely stable, whether it's the fiscal deficit, the current account deficit, inflation, forex reserves. So that's really one of the big attractions for both global as well as domestic investors. And then you have the market valuation, which remains a concern. But once again, once you have the event risk out of the way, I think one can move forward.
Pratik, what has changed from Monday to now? Do you think the market is going to be a little more sort of, smart about ascribing extremely exuberant valuations to certain pockets? Because, I mean, any time a risk could spring up. And case in point here being PSUs, for instance. The way they got clobbered on Tuesday almost gave you a wake-up call.
I think in our view, most of these PSUs in the capital goods and defense sectors were overvalued even before the election results. So that was just a trigger. But also at the same time, we don't think the fundamental outlook on the earnings growth changes. We don't think there'll be a slowdown in defense exports or government infrastructure spending or the state level infrastructure spending or even the journey towards private capex cycle picking up. All of that remains intact. But the valuations were stretched even before the election result, and even if the election result was in the form of a strong majority government, even then we would have said these PSUs are looking, most of the PSUs are looking quite expensive, especially in those cap goods, infra and cap and defense sort of areas. But I think that sort of moderated a little bit, but even then we find these valuations by and large to be on the more expensive side. You've got to have a really long-term view, maybe a 3 to 5 year view if you are investing in these stocks today. Otherwise, at current levels, we find them still expensive.
I think that's a view really for those who are looking at a very near-term move or have just about jumped in onto the PSU bandwagon in the spaces that you talk about. But for those in the money and those who are looking at a long-term perspective, do they really need to worry, and do they need to really cash out at the current levels?
No, we think the long-term outlook is pretty solid. Like I said, the macroeconomic outlook is pretty good. From a corporate earnings perspective, at Kotak, we are expecting about 15% earnings CAGR on a recurring earnings basis for the Nifty 50 for FY25 and FY26, with some risks to the upside. The sectors, however, we think the sectors which have performed in the last 6–9 months, that sector rotation is likely. For example, we think the banks and NBFCs, which haven't done as well compared to, let's say, the more favorite sectors or the more hot sectors like cap goods and infra and defense, we think the focus will shift back to banks and NBFCs in a big way. The other way to also look at it is the street is getting overly bullish on getting overly bullish on infrastructure and defense and so on. But there's also a financing requirement for both government infrastructure as well as for the private capex cycle. And for in that respect, we think the banks and NBFCs look far more attractive. Valuations are far more reasonable. Within the banks, obviously, the balance sheets are pretty good. The NPLs have been cleaned up. NIMs have probably the worst of the NIM pressure is behind us. Loan growth should likely pick up. So, from that perspective, we think the banks and NBFCs are the main sectors to look at right now.
No, for sure, banks and NBFCs, and you touched upon PSUs as well. But, we were just discussing earlier this morning whether or not the appetite for FMCG is back, be it the kind of underperformance they've seen, the valuations that are in their favor, or even the rural push. What is it that you would attribute to the move that we're witnessing within the basket, and does it interest you?
Well, that was just a knee-jerk reaction, what we saw yesterday, wherein just money rotating out of the more expensive sectors into somewhat less, somewhat under-owned sectors. But at these valuations, even the FMCG sector, we're not that convinced. Yes, there is scope for a rural recovery. The monsoons have been good. The K-shaped recovery has been playing out, and finally we're getting to a point where later this year you may start seeing better volume growth. But at least as of now, we think the risks of earnings downgrades are still out there, and our assumption is not that we don't believe the government will get into a big welfare agenda, start distributing money. That could be positive for the FMCG stocks, but we don't see that happening. We think it's going to be more of the usual, wherein the recovery will be slow, volume growth will disappoint. Margins have generally already peaked out towards the upper end of the range. So, and at current valuations, we're not as bullish, but we're not negative either. I mean, we sort of have a more of a neutralish view on the FMCG sector.
Pratik, Kotak as a house was the first one to go cautious on the SMIDs, the small and mid-cap universe. What is your stand now? There has been a part shakeout and stocks are off. Many of them, the large, reasonable part of them are off their highs. Do you think value has started to emerge there, or would you remain cautious on that pocket even now after this shakeout?
Well, there are some pockets of value. We won't say all mid caps are expensive. And also, I think it's not just, it's wrong to generalize between large caps and mid caps. There are some very interesting mid caps, which are effectively the number one players in their respective sectors. So, for example, the largest hotel company or real estate, residential real estate play may not be a mega cap, but these are market leaders in their respective industries. So we like some of the mid caps in the, let's say, in the hotel sector, residential real estate sector, affordable housing, vehicle finance, affordable housing finance. These are the sectors where we think there are attractive mid caps out there. But in general, yes, the mid cap Nifty valuation is probably 40-50% higher than that of the Nifty. And while, yes, there is higher growth, but we still think that the risks attached and the sort of overly upbeat euphoria which was out there it's come off a bit, but that doesn't mean these stocks have become cheap as yet. They're still more on the expensive side.
So other than banks and financials, where is it that you find incremental value on the table?
So I think amongst the large sectors, really banks and NBFCs, then you have to start going into the smaller sectors. One is the residential real estate sector. That's a sector which typically has a very long cycle. We're probably only year 2 or year 2.5 into the cycle. And generally, we don't see the government policies changing too much. We think the interest rate environment will be quite favorable. If anything, rates may come off later this year, as and when the US rates come down. There's a lot of demand out there. The supply is yet to catch up. Supply will take some time to catch up. So therefore, the residential real estate and related to that, the housing finance, the affordable housing finance companies is one sector that we like. Similarly, the hotel sector, again, we think government policies will remain supportive for the hotel sector, for tourism. We think business travel demand will pick up. The occupancy levels will continue to inch up. I think the average room rate increase may moderate going forward, but there's still enough leverage in the system, operating leverage in the industry to drive these stocks higher. And supply is going to take some time. Hotels, building a new hotel takes several years. So that's another sector we like. Healthcare, that's another sector where, again, we believe government policies will remain supportive. There is a huge demand-supply gap. A lot of the top-rung hospital chains are still expanding capacity. There is a big demand-supply mismatch. The average revenue per bed, per operating bed is actually on the way up. Margins, we think, are relatively stable, in some cases going up. So by and large, these are some sectors that we like, but on the large sectors, it's still mainly banks and NBFCs.
Pratik, how are you approaching this energy transition / EV ecosystem play? Is it via the batteries? Is it via battery chemicals, or the renewable power generation companies, or exactly how? Because there's a very wide array of stocks which are available.
Yeah, but unfortunately, most of them are still in the unlisted space. Many of them have yet to IPO, and the handful that are listed, let's say in the renewable energy space, we find them quite expensive. There's a lot, these are more like concept stocks and a lot of massive amount of execution risk involved. And this is even assuming no risks to the government policy in terms of subsidies or any kind of duty, customs duty support, etc. But we think, having said that, the sector itself will grow dramatically. There's no doubt about that. We believe the government will remain supportive. We're not expecting any sharp adverse changes in the government policy. But again, some of these stocks, we think you may want to just wait a bit and watch out for more IPOs coming, which probably will be, there'll be more companies listing in this space. And that's the time to perhaps look at them. The other way to also think about this sector is to stay away from stocks where there is a disruption risk. So for example, you mentioned EVs. We think that is a trend which will take off for sure. And therefore, the two-wheeler sector in particular, we think there's a big disruption risk. Right now, there's a bit of a cyclical rebound expectation on volumes, but that's just more of a short-term trend. Longer term, you could see competitive intensity increase, and that could be quite negative for these companies, which are generating very huge ROCEs, which we think may not be sustainable.
Pratik, always good